Many young companies don't have earnings or even have losses in early years, which makes calculating the PE ratio very difficult. And in order to adjust for that, another ratio that's commonly used is the price to sales ratio. As the name suggests, it takes the price of a stock and divides it by the sales per share of the company. Alternatively, what one could do is take the overall market value, the equity of the company, and divide it by the overall sales of the company. That both of these calculations would lead to the same conclusion. Again, one has to take either this year's sales, next year's sales, or the year after, or even last year's sales, and when making a comparison, the same year's sales should be used for all of the companies that we're comparing. The price to sales ratio has all of the drawbacks of the PE ratio, in that it only captures 1 year's worth of sales, and if sales are expected to either grow or decline dramatically in subsequent years, then none of that would be captured in that simple calculation of taking 1 year worth of sales. What the price to sales ratio does allow is it allows companies to be compared at the top line level based on just their sales, and therefore it avoids taking into account all of the items on the income statement below the sales line, which are basically all the items of the income statement, including cost of goods sold, operating expenses, interest, taxes, and so forth. So in other words, it just looks at things, the overall the outer envelope of the company and its sales, and tries to seek a valuation measure based on that. And if the earnings are very volatile or even low, then we can compare it on a measure that is much less volatile and reflects potentially some of the growth and the current status of that company at a given point in time. Price to sales ratios are often used for companies that are loss-making, often used for companies that have very low earnings, and when earnings are low, they're often much more volatile because a small change in the revenues or the costs in the company would lead us to having very volatile earnings. So the price to sales ratio is like the PE ratio, and it takes 1 year's worth of data, in this case sales, and with all of its associated drawbacks, but it allows companies that have losses or small earnings to be compared on a simple measure. It's one input and it's worth knowing what it is, and again, because it only takes 1 year's worth of earnings and because of market efficiency arguments, it is only one input and perhaps a check as to what the valuation of that company might look like based on the price to sales ratio.